From New York City for our viewers worldwide, I'm Vonnie Quinn. Bloomberg Real Yield starts right now. Coming up, Treasury yields pair declines today after strong U.S. data, those yields remaining elevated. Traders growing maybe less confident in a December rate cut as credit spreads hover near historic tights. We begin with a big issue, uncertainty looming over monetary and fiscal policy.
Markets are still focused on the fundamentals.
There's a digestion phase going on, processing all the change.
We're still digesting what the possibilities of outcomes could be for the Trump administration.
The market trades Trump as a yield curve steepener.
Both the front end and the long end have done a lot of work to reprice higher.
The bond market is very oversold.
When you look at the curve, it's still inverted.
Fixed income today is actually offering a lot of value.
It's very possible that we could see higher yields, higher inflation.
Forward-looking Fed, I think, has to begin to think about how these policy changes are going to impact the outlook.
They probably sneak in a cut in December, although even that's gotten to be a close call now.
They don't have to go too much further to be at the right rate for this level of inflation.
They want to make sure to stick that soft landing.
Our base case is sanguine, but our conviction is low.
Take a look at this chart showing the 10 years steady climb higher over the last month. As you can see, we had another leg higher after the election. Of course, this is much more pronounced in the 2s and the 5-year part of the curve as well. We'll take a look at those a little bit later in the program. But let's flip the board and show you how conviction is in the Fed's rate cutting ability. So the path is dipping. If you take a look at December now, we're at just about 13 basis points priced in January. That is less than 6 basis points. The Fed's next two meetings are going to be real nail biters. And then what happens in January when there is an actual inauguration? And by then we may know the Treasury Secretary. We may know the Treasury Secretary by the end of the day. Lot for the market to digest and a lot coming. Well, speaking of the Fed, take a listen to what Fed Governor Mickey Bowman had to say on her dissent on the 50 basis point cut back in September.
I preferred a smaller initial cut in the policy rate. With inflation continuing to hover well above our 2% goal, I saw the risk that the committee's large policy action might be interpreted as a premature declaration of victory on our price stability mandate.
Joining us now, Reiman of UBS and Tony Rodriguez of Nuveen Asset Management. And thanks to you both. I hope you've had some sleep since the last time we spoke to you, which was pre-election. So, Kurt, let me begin with you. What Mickey Bowman did, as in dissenting, was a little bit odd at the time. Now it looks slightly different. Is there a chance that we may not get a cut in December?
We have a bit of an out of consensus view on the Fed. We still think that Fed policy is in a restrictive territory, even with the rate cuts that we've seen so far. The economy is doing fairly well, but our expectation is that over the course of the next year, shelter costs start coming out of a lagged effect out of inflation, keeps inflation moving back towards target. And that there's room for the Fed to continue to cut one more time this year and then another 4 in 2025. So another 125 basis points over the course of the next year and so.
It's funny that that's actually the out of consensus view right now. Tony, let me come to you and ask you, have you changed your mind at all over the last few weeks over what might happen? And particularly given what Kurt has just said, that he still sees that many cuts by the end of next year.
Yeah, well, good afternoon, Vonnie, and good to be with you. Yeah, so I'd say our view lines up a little bit with Kurt's, but not quite as aggressive on the cuts. So our view is that we probably will see a 25 basis point cut in December. We also think growth is going to moderate, but we don't think it's going to moderate as much as we had expected, say, prior to the election. Having achieved the red sweep, we think the probability of some very aggressive fiscal policy, meaning that the tax act gets renewed, and therefore larger fiscal deficits than one might otherwise have been expected by the markets, will now help to support growth a bit more than we might have expected prior to that red sweep. As a result, we basically kind of removed 50 basis points of cuts from our 2025 forecast. So we would expect 25 in December, another 50 next year, sometime between ending in June to maybe September, depending on the data and depending on the policy, because there's clearly some countervailing policy risks coming from the trade and immigration side. But net today, we land at 25 in December, another 50 in 2025 as we continue to see relatively healthy growth and continued moderation in inflation, but somewhat sticky, only modestly below current levels.
Now, that's a big difference. So you're pricing in 75 basis points of cuts between now and the end of next year. Kurt, you're pricing in 125. That's a 50 basis point difference. And in this economy, that's a lot. How can you have so much conviction in your call, either of you really, given that we don't know who the next Treasury Secretary is going to be? We don't know what's really going to happen in Congress. We haven't even had the president-elect inaugurated yet.
Yeah.
And the economy was already a little bit on an uncertain path.
Well, that's right. Now, so the tax cuts that, if they are extended, I think one thing that's important to consider here is that they may add to deficits, but they don't add to growth. They're not stimulative. If you keep tax rates where they are, we just get the same impulse. We would have to see more. We'd have to see corporate tax cuts. We'd have to see some of the other promises that were made on exemptions on tips and Social Security income and overtime pay to start really see this be a boost to the economy. So from our point of view, we're not trying to be heroes here in the bond market. We like the value that we're seeing. We're moving out of cash. We like the belly of the curve. We're positioning in the 5-year. But you don't get paid to go much further out the curve. You don't pick up enough additional yield to go out into the 10-year and 30-year, where, to your point, there is some volatility that we can still expect around the implementation of policy and the appointment of personnel, and whether Congress will play ball with the administration on many of the proposals that they made on the campaign trail.
Well, and even on those tax cut extensions, we're looking at the end of next year, by which time we could have a very different economic policy picture, right? Kurt, I want to ask you, how much do we need to think about 2026 and the potential for a different Fed chair?
Yeah, I don't think that's necessarily what we're, thinking about for the bond market right now. The Fed chair is going to likely continue policy along this idea that we have a restrictive policy. By then, we expect it to be pretty close to neutral. What we're going to be expecting is that what's around the economy, how is inflation migrating? I think those are going to be key for the next Fed chair, because to Tony's points and to some of your points earlier around trade, around potentially increasing deficits, we've got to be on the lookout for higher inflation. And from our point of view, one of the reasons why we're not going further out the yield curve and picking up more interest rate risk is that we can't rule out the possibility that we see the 10-year moving to 4 3/4 or even 5%.
Yeah.
And it's really about whether the Fed chair is continuing to push this policy of getting inflation back to target.
Right. And Tony, let me ask you about that, because we are at 440. We have had a backup in yields. We are sticking around that level, as sort of a small range at the moment. How much of this is pre-pricing in the impact of tariffs? We don't even know what they're going to be yet.
Yeah, well, Vonnie, you make a great point. I think everybody's confidence in their base case is relatively low because of all the uncertainty on policy that we expect to see, which is on top of just the general uncertainty we always have around data, around geopolitical risks that are out there. But our view is that, again, you're going to see more fiscal stimulus than you otherwise would have. So that's good for growth. And the policy that could come in around immigration trade, those definitely have some medium-term growth dampening implications. So whether it's Powell and this current Fed in the second half of next year, or it's a new chair in the Fed in 2026, we do think they're going to just have to navigate what the actual policy implementation looks like and how much of that is maybe driving some near-term inflationary impulse, for example, higher tariffs across the board, versus the more medium-term, we think, negative growth impulse that could come from that lower trade environment, maybe diminished labor supply because of immigration policy. So I think it's going to be a pretty complex cocktail for the next Fed chair and the current Fed in the second half of next year to have to navigate.
Can I just briefly ask you both, are you looking at the possibility that the Fed chair, the current Fed chair, will get fired at all, maybe on a whim or maybe premeditated? Is that a tail risk that you're factoring at all? And what would you do if it did happen to happen, if you're not factoring it in now? Tony?
Yeah, well, we think that's quite unlikely, because we do think that if they attempted to fire him, it would end up basically in a very protracted legal scuffle between the Fed and the administration. And given that the chair's tenure is over in 2026, we think the administration will just kind of be patient, The Fed is right now on a course to cut rates. So I think that's consistent with what the administration would probably prefer at the moment. So we don't expect it to turn into, we don't expect them to be fired, and we don't think it would be an issue for the market.
Kurt?
This is a big question that our clients have been asking us all year. And I would just say that in a nutshell, we don't expect anything to happen with tampering with the independence of the Fed under the new administration at all between now and the end of Powell's term in 2026.
Very briefly, you talked about dollar strength for a brief period of time if it were to be a Trump win, but that would come out of the market pretty quickly. We've had 8 weeks now of dollar inflows. How long more does this last?
We're more of the longer term view that we will get the dollar to weaken, but what is the impulse that's pushing the dollar higher? It's concerns about trade. It's the possibility that we'll get a bigger growth impulse out of the U.S. The Fed will be slower to cut rates than the rest of the world. That's what's influencing the dollar right now. But if we extend our lens to the middle of next year, the end of 2025, we expect the dollar to be lower then.
Guys, we could talk all day, but we have to leave it there. Unfortunately, our thanks to Kurt Reiman here on set of UBS and Tony Rodriguez of Nuveen. Up next, the auction block. The credit market heading for a strong finish to close out the year with high-grade sales for November nearing $100 billion worth. This is Real Yield on Bloomberg. I'm Vonnie Quinn. This is Bloomberg Real Yield. Time now for the auction block, where credit issuance is finishing strong to close out the year. High grade was busy this week with volume topping $36 billion, easily beating estimates. Big names like Alibaba, Morgan Stanley and JP Morgan helping to drive those sales. Those numbers putting November volume just below $85 billion. And for the year, sales have now climbed to the second highest level on record. And I want to mention one sale this week that did not happen. Adani scrapped a $600 million offering after U.S. prosecutors charged its founder with participating in an alleged bribe plot. Its bonds across the board took a hit. Back to credit here in the United States. BlackRock's Amanda Lynham saying strong growth can support these tight spreads.
I think the net here of everything is that corporate credit is in a pretty good place. It all boils down to growth. If we have a supportive growth backdrop, I would say manageable tariff risk, and then I would say the continuation of yield-based support plus some favorable technicals, that's a recipe where credit can stay in its current tight range or even move slightly tighter.
Joining us now, Lotfi, Karoui from Goldman Sachs and Stephen O from PineBridge, and thanks to you both. Lotfi, I want to start with you. It is a challenging valuation environment. What's good about it?
Yeah, I mean, we're going into 2025 with probably the most severe valuation constraints for spreads over the past 40 years. What's good about it, and why would you buy credit at these levels? I think you buy it for the yield support. Yes, spreads are very tight, but the base rate, which is driven by the level of the Treasury curve, is quite attractive. So if you take IG as an example, under conservative assumptions, it's very likely that your total return for 2025 will be around 5.5%, which is a very decent value proposition. The other thing I would add is that you're getting a pretty good embedded hedge from the duration component. And so hypothetically, if tomorrow we have an accident in this cycle and a full-blown recession, that duration component is going to act as a very nice embedded hedge to you. And so it's really a yield conversation at this point rather than a spread conversation.
Well, Stephen, given what Lotfi said, how do you decide what to do here? Because there seems to be a range of possibilities that might actually happen in 2025.
We wouldn't dispute the general notion that the fundamental outlook for credit is quite supportive of very tight spreads, which are persisting today. But in terms of portfolio positioning and what do you do in that type of environment, despite the strength in credit spreads, when you're trading at hyper bullishness, I think the net bias is to be more defensive in nature. But historically, defensive would imply, particularly heading into an easing cycle, that you become higher quality in nature. But in the current environment, defensive for us means you get closer to beta and more diversified. And then the other thing that we would do is look for opportunities to add assets that represent dry powder without sacrificing yield. As a direct example of that, you can buy AA CLOs today with a higher yield, current yield, than BB high yield bonds. And so by shifting some of your exposure to this dry powder, but at the same time not sacrificing yield, you look for those types of relative value opportunities to both diversify your exposure, but also shift into areas that could provide some greater protection, yet at the same time, you don't want to sacrifice yield in this type of environment.
How far down the spectrum would both of you go? We had Marty Fritzen saying that credit spreads are artificially tight due to the things like the private debt boom and also central bank support changes in the investor base and so on. But yet junk bonds have been notching up gains. We're having a great week. Triple C's on track to be the best performing asset class this week. Lotfi, let me start with you.
Yeah, I mean, we liked triple C rated bonds about 2 months ago when they were trading, well above their historical medians. But the rally of the last couple of months has been very impressive. I mean, triple C rated bonds have sort of joined the rest of the credit ecosystem in terms of being stuck in a valuation conundrum. So as an index view, we don't see a lot of value in triple C rated bond at these levels. I think most of the opportunity set has shifted to the single name level. But the story in high yield, in my view, is there's an index view, which is tight spreads. If you scratch a little bit under the surface, what you see is that dispersion is still elevated. And so it's mostly a name-picking game at this stage as opposed to some kind of a triple C alpha type of strategy.
Lotfi, are there any areas you're completely staying away from? We, from time to time, get warnings, and it seems like real estate, for example, has been getting warned of more often than other industries, but perhaps there are others out there.
We actually like real estate. It's sort of one on the debt side, at least. It's one sector that is poised to benefit from easier monetary policy. There's a good chunk of the debt complex that floats, and so there's a mechanical sort of pass-through from lower policy rates. And I would say, unlike triple Cs, actually there seems to be some convexity there. So things like CRE CLOs are a good example. Single asset, single borrower, CMBS is another one. These are sort of niche pockets of the market, but they do offer more convexity, I think, than corporate credit.
Stephen, let me get your response both on the spectrum question and on the riskiest parts of this market.
Yeah, within the spectrum question, our starting point this year was that the portfolio should be barbell. So you should buy high yield and treasuries as opposed to necessarily the investment grade part of the capital structure, with the base case that high yield and the higher risk components would outperform. But you wanted a defensive element given the spectrum of risk that persisted going through the year. We would say that we're in a similar spot where we are as of today. But how do you take that below investment grade exposure? So as an example of that, right now, if you look at floating rate credit in the form of syndicated bank loans versus high yield bonds, while recognizing that high yield is higher quality, if you look at single B to single B, you're getting about a 200 basis point pickup there. And in a year, next year, where yield will dominate, you want to go where there is a yield advantage that would be very hard to make up from a price appreciation standpoint. With respect to triple C area, the market is being very disciplined in not necessarily issuing new issue triple C. And the current volume of triple C is very much sort of dispersed, as noted by Lotfi. And you got to pick and choose there as opposed to thinking about investing as a category altogether. And then with respect to asset classes that look positive and negative, we think Asia high yield, despite the tremendous run that it had this year, and even though the sentiment may be negative based on potential tariffs against China, China is a very small component now of Asia high yield. And we think Asia high yield offers a very strong value proposition still relative to developed markets. And then, there are pockets of opportunities where there's still distress, as noted. I think parts of the real estate market where there's still a lot of fear means there's going to be a bit more opportunities, but even marginal opportunities, right? Things like MBS over IG corporates represent better value today. So it's really about relative positioning.
Lotfi, there are so many things to think about and so many wild cards because, for example, we also have this escalation potentially of hostilities in Russia, Ukraine. There's also the idea that we don't know which person is going to be the Treasury Secretary yet. It could be any of the ones mentioned or even somebody new. And then there's, the idea that, well, how much can the economy actually take in terms of Fed cuts before we see inflation perhaps becoming a problem or before the labor market gets hit? Which of any of those is the most concerning to you right now?
Probably the policy agenda. I think any escalation of tariffs risk into 2025 would be viewed, number one, as a negative growth shock, and I think it would put the Fed in a pretty difficult position. So that's the type of scenario I think that would sort of bring us back to where we were in 2022, 2023, where investors were hit by a double whammy of higher rates and wider spreads. And so I would say escalation or the risk of a full-blown trade war would be the number one tail risk for 2025. The discussion about sort of U.S. debt sustainability is something that comes up all the time in our conversations with investors. To me, if you look back at the last 3 weeks, the read-through so far from the market is that it's treated sort of the post-election outcome as a growth shock in a positive way as opposed to a fiscal shock. That's actually quite reassuring. But that could also shift into 2025 once come January and we have more clarity on the policy agenda.
Very briefly, any preference on a Treasury pick in terms of steering markets-wise, at least?
We would actually take the other side of the recent repricing and Fed cuts. We think that's a little too hawkish. The baseline is still for 4 cuts in 2025. I think the market is obviously lower than that.
All right, we have to leave it there. Thanks to you both. Very appreciative of your time. That's Lotfi Karoui of Goldman Sachs and Stephen O of PineBridge. Still ahead, the final spread, the week ahead. A full slate of economic data in a holiday-shortened week. This is Real Yield on Bloomberg. I'm Vonnie Quinn. This is Bloomberg Real Yield. Time now for the final spread. The week ahead coming up. Monday, G7 foreign ministers meet in Italy. Plus, we get earnings from Zoom. On Tuesday, we get those FOMC minutes and more economic data Wednesday. We have that full slate of data ahead of the Thanksgiving holiday, including the all-important PCE, which might show a little softening in places, at least year over year. Then, of course, Thanksgiving is Thursday, so U.S. markets are closed. And Friday, well, that's Black Friday. Plus, we get a general election in Ireland. From New York, that does it for us. Same time, same place next week. This was Bloomberg Real Yield. This is Bloomberg.